hello and welcome to RJS TV, the September edition, the first of spring, and Roy Sanderson has sprung into the studio with a bit of a spring in your step because...
up and about, Dave.
There is plenty going on. We won't talk about footy, but there is plenty going on in that space, and there's plenty going on in the economic and finance space, also the tax space that we're going to talk about. Now, Roy, before we get to our economic indicators, the last thing I asked you on the last show was what your predictions were for this time, or for this show in September. You said that interest rates would be on hold, and you said that inflation would be slightly down. So let's get into our economic indicators and news headlines and have a look at how you went with that prediction, because the first one is the indicator that we've been watching for the last few months with eager anticipation, and it is interest rates, and you were spot on. 1 from 1 there.
Nailed that one, and I don't expect another interest rate rise. I'm expecting that there's going to be a soft landing on the economy, and I think the inflation rate will continue to just come down slowly. They don't want a recession, and therefore I think the Reserve Bank will make the decision that we've seen the last of the interest rate rises.
There you go. A bold prediction there. And Roy, you know what? I'll double down on that. I'll agree with you. I think that interest rates have peaked. The next movement that we see will be down. So there you go. I mentioned your 1 from 1 on your predictions. The second prediction was a slight decrease in the CPI, or in inflation. Let's have a look how you went. 2 from 2. Bang, bang. A slight decrease in the CPI. And you can see there, Roy, that the trend is downwards in inflation over an extended period of time, particularly during the first the first 9 months, I should say, of 2023.
And this is why I think the Reserve Bank will put a hold on any further increases. I don't think we're going to see decreases for quite some time, though. I think they're certainly in next year, not this calendar year, I think it's good news, but the inflation rate, that movement was bigger than most people expected, and I don't expect such big movements going forward, but there will be slight reductions in the inflation rate going forward, I'm sure of it.
I want to use a strange analogy here, Roy, so stay with me. You know, a lot of people talk about, at AFL clubs, the list manager being an important cog, but only recognising success down the track in the future. During the month, we saw the resignation, or the finishing up, of the Governor of the Reserve Bank, Philip Lowe. Now, he has been lambasted in various circles, but perhaps down the track we will see that his strategy was actually successful beyond his tenure. What do you make of that? Because, as you said, we've both now predicted that interest rates won't go up anymore. We've seen inflation come down. Isn't that job done?
Yeah, I would say job done, and I've been rather critical of Mr Lowe and some of the things he has done, but the history will show that in a time when we needed certainty, because we had COVID, he said interest rates will not go up until 2024, and he got that wrong, because around the world interest rates had to go up because of inflation. So he got it wrong, and they started increasing interest rates, and we were all very critical of him, but history will show it was right to say what he said because it gave certainty, and then when he had to change his mind and flip and go, well, I have to increase interest rates, he was right to do so as well. So not a bad outcome in my opinion.
Let's have a look at another indicator that we observe very carefully on this show, consumer confidence. And this one, Roy, is sagging. It's still at a really historically low level. We mentioned a few months back that those back-to-back 78.5s in February and March this year were the first time that we saw back-to-back consumer confidence that is sub-80 since the early 1990s. So that gives a bit of context to where we're at historically. We've now had 5 readings that are sub-80 across the last 7 months, and people's outlook for the next 5 years dropped as part of the sub-index of this one, as did people's appetite to buy a major household item at the moment.
Isn't it interesting? We don't know exactly what causes consumer confidence, but the reality is, at this time of the year, every year, this is when we get our tax refunds, and this is the space we work in, our wheelhouse. And we know that because the government got rid of the low middle income tax offset, there's at least $1,500 per household less in a refund compared to the last 3 years. So there's less money going into the economy this year compared to prior years. And I know when we talk to people and doing their tax returns, they are so disappointed. And that can affect consumer confidence because they didn't get the $1,500, their refunds have dropped, they can't go out and spend money on the TV or the things that they were going to do.
Yeah, it's an interesting point. As you say, one of the themes of the last 5 minutes has been this idea of managing expectations. Confidence is basically a byproduct of expectation, isn't it? As you say, it's not a rational thing. It's more around managing expectations. The governor got it wrong at one point in time, but perhaps corrected it. And now people are sort of still feeling on edge, despite the fact that interest rates are on hold for 3 months in a row, despite the fact that inflation is trending down. There is perhaps reason for narrative that things are better than they are. We've still got very low unemployment as well, but it's not cutting through because of the tangibles, like not getting a refund at tax time. So I think that's a good point, Roy, and it's why we look at that consumer confidence index so carefully each month, because there are so many variabilities in that factor. There
are, definitely.
Business confidence is another index that we look at every month. This has a bit more variability than the consumer confidence number. This one is up for the second consecutive month, Roy, and I mean, it's no wonder. I think moving on, we have seen a slight drop-off in corporate profits during Q2, as we'll see in the next slide. But Roy, what I really wanted to talk to you about is this idea of corporate profits at the moment is very much in the news. We see ASX 50 companies day after day announcing record profits. We saw grocery companies, we saw airlines, obviously. There is massive profits being made. And just to give some scale to this, I wanted to draw your attention to the next graph, which is corporate profits over the last 25 years. So you can see at how high they are historically compared to the last 25 years. And remembering that the last 25 years has been basically economic boom, with one recession thrown in there, which was caused by the global pandemic. So pretty extraordinary that we are seeing corporate profits at that level that they are.
Yes, and there's a fine line between a fantastic corporate profit and an obscene corporate profit. When a bank makes a $10 billion profit, there's where do you fall, one side of the fence or the other? So we want them to make profits, we want more taxes paid. But it's an interesting space where the taxman could step in and start taxing super profits, I think they're calling it. Anything that's a super profit gets a higher tax rate. So I might mention a little bit later.
Save that thought, Roy. Save that thought, because I know that might pop up later in the show. ASX 200 and its movements, Roy. Talk us through this one.
I wanted to mention this one because if you just look at the graph, and we're talking way back to the 1980 timeline, the graph is always up, despite all the bounces. But if you look at right to the far right of that graph, it's been flat for 2 years. And when it's flat for 2 years, we often get a big increase. Now, I'm expecting that 2024 and 25 will be good years. I don't recommend that you just go out and buy a mix of shares. I recommend you go and see a wealth manager and get some advice on the best shares, not the 200 best, but the best 20, best 15, which will eclipse what the average is. They'll do better than the average. And I'm just saying, if you're going to buy shares, now's the time, because I think the next 2 years are going to be great.
Interesting stuff. Plenty of good information on RJ Sanderson TV today from Roy Sanderson. Roy, property is another investment option that we look at on this show quite carefully. Talk us through the quarterly changes in values over the last quarter.
The fact is, our firm does specialise in property investment, so we have a bias towards property investment, despite the fact that we have a wealth management team that give advice on shares. The key here is, if you look at the left-hand side, the 3 months, and right at the bottom you've got Brisbane going up 4.2% in the last three. This is dwelling values, so last 3 months. Melbourne 1.6 and Sydney 3.8. The average across all combined capitals is 3.1. This says that property has turned the corner. Where it was going down post-COVID, it's now going up. So that's a good turnaround for the property investment market.
And in terms of the number of properties that have been listed, Roy, talk us through this one.
So this shows that the number of properties has dropped from around the $20,000 mark to just under 150,000, 200,000, sorry, to 150. So about 50,000 less properties being listed. So when the media get hold of, we've had a 74% success rate on sales. That's partly on the back of the fact that we've got 50,000 less homes being sold. So there's less properties on the market at the moment. So what effect will that have on property prices? It means property prices will go up because we have less properties being sold. That's supply and demand.
Supply being a key focus of government at the moment and of the parliament, and plenty of deals being done in that space. But the question is enough being done? Let's have a look at rental annual changes now, because rents are up, pushed by that lack of supply at times, but obviously with high rents comes opportunity for someone.
Yes, and this is I'm trying to push here the understanding that property will go up because rents are going up and the prices will follow. And although the right-hand graph shows 9% across all of Australia, on the left-hand side I've highlighted, Sydney right at the bottom, 11.8%, Melbourne 13%, and Perth 13.7%. They are huge increases. That's rental increases in the last 12 months have gone up, 13% in Melbourne. That's a huge number, and that's going to force property prices to go up.
The other thing that is potentially going to force property prices up is rental vacancy rates, because they are quite low compared to history here, Roy.
Yes, I've put a little red line around the 3% mark here. That 3% is the average since this graph started. So we're talking around about 20 years here. And right at the moment, every single state is below the 20-year average. So we have less vacant properties now than what we, on average, we've had for the last 20 years. So if we have less vacant properties, that means that rents will go up. If rents go up, and they'll continue to go up, that means we have house prices that will go up.
And then another upwards pressure on rent is going to be immigration, Roy.
Yes, and this is part of our problem, is that we have more people coming into Australia than what we've had ever in the history of Australia. So we're at 400,000 this year, and there is a plan to drop it back to 315 and 260. But the reality is, right now, we're having to house 400,000 people, new people coming to Australia. And I think the government need to actually just get this right, and they need to ease it a little bit more. And whether a 315 is right or 260, I'm not 100% sure, but this is part of the reason we have pressure on vacancy rates, we have pressure on rents, which is going to force house prices up.
Dwelling approvals can also be a factor in terms of rent and the price of rent. What do you make of dwelling approvals at the moment, Roy?
Well, dwelling approvals for both houses and units are below the 5-year average, which is the line on the right-hand side. That's the 5-year averages for both of them, and we're well below them. So if you actually look at what we are building right at the moment, or what we're approving, I should say, we've got 8,000 and around 6. So you've got around 13,000. I think the exact number was somewhere around 13,200. So we've got 13,200 being built for 400,000 new immigrants. The numbers don't stack up. We are not building enough for the number of people that are coming to this country. To suggest that the statistics show we're down 19% in one sector and 8% in the other sector. So this is a housing crisis that the government needs to see and understand.
Speaking of property and the property sector, the AFR Property Summit was held the other day. Tim Gurner, the CEO and Managing Director of Gurner Group and a big property developer himself, had this to say.
I think the problem that we've had is that we have people decided they didn't really want to work so much anymore through COVID, and that has had a massive issue on productivity. Tradies have definitely pulled back on productivity. They have been paid a lot to do not too much in the last few years, and we need to see that change. We need to see unemployment rise. Unemployment has to jump 40, 50% in my view. We need to see pain in the economy. We need to remind people that they work for the employer, not the other way around. I mean, there's been a systematic change where employees feel the employer is extremely lucky to have them, as opposed to the other way around. So it's a dynamic that has to change. We've got to kill that attitude, and that has to come through hurting the economy, which is what the whole global, the world is trying to do, the governments around the world are trying to increase unemployment to get that to some sort of normality. And we're seeing it. I think every employer now is seeing it. I mean, there is definitely massive layoffs going off. People might not be talking about it, but people are definitely laying people off, and we're starting to see less arrogance in the employment market, and that has to continue because that will cascade across the cost balance.
Roy, plenty to unpack there. What did you make of it?
I don't disagree a lot with what Tim says, and he's a great operator and a nice person, and got a great building company, and you don't kick somebody because they're successful. You actually should pat them on the back, and he's been very, very successful. And I don't think he's wrong. He says that unemployment needs to go up by 40, 50%. That's not to 40 or 50%. That's saying the current rate, which might be around the 4% mark, needs to go up by another 2%, being 50% of 4, so around 6%. And we don't know where unemployment is at the moment. Are we at full employment? Is 4% full employment, or is 0 full employment? His comments about productivity in the building industry, 100% right. I see it from clients we have so many clients in the building industry, and he's right where when we got to COVID, we came out of COVID, people didn't really want to work. They were being given a lot of money to not work. And that psychology needs to change. It's not good for our economy. It's not good for our culture. So I give Tim a bit of a tick on some of the points he's raised.
Yeah, it's interesting. I think listening to that, and obviously it was a very catchy news grab for everyone. It's been everywhere over the last few days. The question, there's a lot of question here about the context, but perhaps if you apply it to one particular industry, it makes sense. But I mean, my first thoughts on that are that I see that 25-year corporate profit graph, and I think that businesses are going okay. I think that we've seen real wages drop over the last year because of that rising CPI. So I feel like employees have copped a rough run in the last year, despite the fact that there is favourable employment at the moment. We're at record or near record unemployment. I disagree with the idea that unemployment needs to rise. I think there is a new expectation in the community that unemployment or full employment is attainable, or is more attainable than ever. I think that we live in a new post-COVID world where flexible work and opportunities for people that haven't necessarily had opportunities in the past are more accessible than ever. But again, I think that there's some context that's lacking in this. Is this applicable only to the building sector, where we do know that there are some seriously some big issues? We're seeing a lot of insolvency within that industry, and you know, I think that there's going to be questions that come for employers as well as employees. Are margins too slim in that industry? Do we need to rethink the margins in that particular industry because of the pressure on supply that's happening around the world? So context is everything. I'm not going to sit here and say I think Tim's wrong, but I think I certainly disagree with some of the points, and that's why we're on this show, to unpack the big stories, Roy.
Yep. Well done, Tim.
Let's get into a tax tip now. This is your area. You are the absolute authority on this area, Roy. First tax tip, we're going to super. What have you got for us?
I think this is gold for anybody who's over 60 years old. If you're over 60, you would know, or should know, that you can take out your superannuation money tax-free. So let's say you do take some money out, but you can also, while you're working, you can contribute money to a superannuation fund and claim it as a tax deduction if you lodge a notice of intent to deduct super. Now, here we go. What happens if I take $10,000 out of super and it's tax-free? I then take that money and I put $10,000 into super and I claim it as a tax deduction. And depending on my tax rate, let's say you're on average at 34%, that will save you $3,400. So there's a tax tip of just moving some money from one bank account to another. It's all yours, and you save $3,400. Depending on your super balances, depending on your income, you actually may be able to do a lot more than $10,000. But you should speak to a wealth manager. Don't go out and write on the notes, Roy told me. Definitely speak to a wealth manager, and you know, one of our team, or any wealth manager, preferably one of our team, by the way. But that's a fantastic tax tip for anybody over 60.
There you go, rjsanderson.com.au to get involved. Tax tip for small businesses as well, Roy. What have you got for us here?
My second tax tip, I don't think this is well known in the industry. It affects anybody in business, so sole trade, a company or a trust. This extra 20% means if you spent money from 30th of March last year, 2022, through to the 30th of June, so you've actually got to go through last year's transaction history, and you get to claim not only what you spent in that year you spent it, but in this tax return you get an extra 20%. But some of this technology's definition of spending includes things like computers and laptops, internet. Every business has internet, so you're going to get an extra 20%. What about IT? You bought a computer, you pay an IT person. You've got a web page designed. Some of these things, every business are spending. Subscriptions for MyOb or Xero. You've paid all year since the 30th of March, so that's going to be somewhere around 15 payments, and you get this extra 20%. Good accountants are looking out for this for you. Make sure you as a business owner are prompting your accountant, or come to RJS, because this is our wheelhouse.
I can just hear the passion. There's passion there because there's money on the table, isn't there?
There's money on the table. It's available to business people. You have to take advantage of it. And I don't want to find that some of the accountants in our industry are not staying up to date with these rule changes, because there's not been a lot of media publicity for this point, but it's a great point.
Tax questions have come through as well, Roy. Question 1. We're going to put you under the microscope here. Due to a death in the family, I am about to inherit a lot of money. Is there an inheritance tax in Australia?
Definitely no inheritance tax in Australia. It's been gone for many, many years. But be aware that when you inherit money, there are different components. You may inherit the family home, which means that there's no capital gains tax when you sell that if it's sold within 2 years. You may inherit shares or something that was purchased prior to capital gains tax on the 20th of September 1985, and you inherit the cost base, but because it was pre-capital gains tax, the cost base is when at the date of death. So those shares, you only pay tax when you sell them. Anything that you inherit, no tax is payable until you make a sale of the asset. Family home exempt from tax if sold within 2 years.
It's interesting. You know, it is a bit of a political topic. It's probably not, too prominent at the moment, but it is an area that, there is international precedence in. So, if you do come into some inheritance money, you probably need to think about that quite quickly at the moment and get in touch with the RJS Wealth Management team.
I might add that superannuation that's paid upon death, if it's paid to a non-dependent, then it's taxed at certain rates. So people who are getting elderly should have some estate planning to make sure that the tax that's paid out of super is reduced. There are some things you can do before you pass away that's going to save your beneficiaries, your children or grandchildren or whoever's inheriting a lot of tax if you do it right. So get some wealth management advice around those issues.
Second question that comes in from a viewer. I am a nurse and work at the Austin Hospital. They do a great job. They birthed both of my boys, Roy. They do a fantastic job there. Can I claim parking?
You would love to say yes, but unfortunately parking where you normally work is not a tax deduction. However, to that nurse, if you got sent off to work at a secondary place of work like the Monash, and Monash is not your normal place of work, parking at the Monash for this visit would be tax deductible, but any parking at your normal place of work is not a tax deduction. I'll just say there is an exclusion to that, which will be people in the construction industry who may have tools in the car. So just think about that, but generally parking is not tax deductible. Sorry to the nurse.
There you go. Now, I think you sort of teased this one earlier in the show, but one of my favourite parts of the show, as always, every month, Roy's Rage. Where are you going with this one, Roy?
There's a report that comes out every year. It's called the Intergenerational Report. The idea is that it talks about things that are going to happen in the future generations, and what the taxation system should or might look like in years to come. Now, some of the things that they came out with or their recommendations, corporate and mining super profits tax. Now, I'm a big yes for that. I've been promoting it. I think I invented it. I'm claiming it.
Bang.
So anything over $1 billion is taxed at not 30%, but at 40%. That would be the way I do it. And that would be a big company adding more to our tax coffers that we need. But the next three recommendations I am very much against. A 15% levy on superannuation once you're retired. There should be no tax on super. You play with our superannuation and you will lose an election and not get voted in for decades. So don't touch that. Medicare levy increase for high income earners. Medicare levy, the levy was invented because a government went to an election and said we will not add any more new taxes. They added 2%, called it a Medicare levy, not a tax. I believe 2% is enough. I don't think that you should be hitting high income earners. But this is the worst one, wind back negative gearing. So we need property investors. I've spent some time today explaining that we have a housing shortage and the reasons behind it. One of the problems we have is that property investors are leaving the market. And if we wind back the benefits for property investors, we'll have less houses to rent because there's less property investors. That means our taxes, government money, will need to go towards housing because policy got it wrong in the preceding years. We have to get that right. We actually need to go the opposite. We need to encourage and give tax support and benefits to rental property investors.
Plenty to unpack there, Roy. It's interesting now, questions without notice, because as you're reading this, I did notice a point that we're talking about the intergenerational report, and lo and behold, we've got an intergenerational desk here. So I think that there's some interesting insight that we can have between the two of us, because one thing that I read on the intergenerational report that I think is horrendous is that it predicts 40 consecutive years of budget deficit. Now, to me, like I remember, and I'm going to tell you a little story here, Roy. I remember where I was the first time I heard about Australia's ageing economy. This was back in 2007, and I was in a high school classroom. Now, unfortunately, we've got to this point, you know, what are we, 16 years later, where lo and behold, the economy has aged and we've still got an ageing workforce. So I'm with you on one of them. I am dead against a Medicare levy for high income earners, because this is a problem that should have been solved 15 years ago when we already knew that the economy was ageing. I'm also with you on the super profits tax because, as I've said already on this show, corporate profits are at record levels at the moment. This needs to, and particularly off the back of minerals, which is essentially horse trading sovereign wealth, this needs to change. So there's plenty to unpack there.
I 100% agree, Dave. There's so much happening at the moment.
Right, let's get into our shout out, because this is a time where we give a local business a plug, and this month we've got Digital Growth Creative. A very familiar business for me, Roy. You tell, but I'm sure very familiar for you as well.
Well, I'll put a proviso here. They're a related party. They look after the RJ Sanderson website. They do a great job, and the website design, development, digital marketing, search engine optimization. They are Australia-based. They're not based overseas. Contact them if you want a website or you want to freshen up your website, because remember, in today's world, our shop front is actually our website. We don't have as many people going through shopping centres. They go online. So if you don't have a good website that looks fresh and great, then you're missing out on sales. So talk to Digital Growth Creative, and James there will look after you.
Roy, you went 2 from 2 in the predictions last start. What's the prediction for October?
I think we won't have interest rate increases. I think inflation will come down. I think consumer confidence will come back a little bit. I think business confidence will level out because it's actually gone up 4 months in a row. And unemployment will be interesting to see what happens with unemployment, but I think it'll be fairly stagnant.
Some bold predictions on the table there, Roy. It's been fantastic. Thanks to you, as always, September RJ Sanderson. It's been good fun.
Thanks, Dave. It's been a great month.
And I'm sure that Roy will be hoping that September gets even better for everyone. If you're a footy fan, good luck to your team in the finals. My team not there, Roy's team is, but it should be a good month. Spring has sprung. Enjoy the rest of the month. We'll see you in October.